In this video, guys, let's look at how to distinguish between good and bad trading strategies. Stay tuned. Hey traders, warm welcome to you. Thank you for joining me. All right, so good and bad trading strategies. What does it mean? What is it all about? And how do you define the difference between the two? Now listen, you're going to obviously say, hey, if a trading strategy is making you money and it's profitable, it's a good trading strategy, but it's not always as clear as that. Now, obviously that is something to take into account, but don't get too caught up on that, because just because something's not profitable now in the current market conditions doesn't mean it can't be profitable in different market conditions. If you're using a mean reversion trading strategy in trading market, talked about before, you're going to get your face ripped off. If you try and trade trend trades and breakouts in a kind of range bound environment, again, face ripper. So it doesn't mean that you can't use those, but just in using them in the right environment. So profitable, fine, fair benchmark, of course, but not get too hung up on it. Real things are kind of some of these kind of 5 extra points that I've kind of pulled out of strategies and gone, okay, these are things you really need to focus on, in my opinion. And let me know what you think, guys, in the comment section below, as always. Real risk in the strategy. So what does this mean? So trading strategies can look great on the face of it. You know, an obvious one is, which many of you probably don't trade, is options. Selling options is like you get premium, you're selling insurance, you take money, you collect premium, you collect premium, you collect premium, you collect premium, and it works fine. But the hidden risk is one day you have to pay out on the option. So that would be one. Another one would be, I've talked about these before, where some of these social trading guys who are at the leaderboard gaming the system a bit by adding and adding and adding and adding and adding to the trade, and keep adding, holding lots of unrealized P&L, hoping it comes back. Now that may look statistically like a very nice trading strategy, 90% profitable, but the hidden risk is, wow, if that thing keeps going, you're wiping out. You're literally so vulnerable. So there's all sorts of different things. We have to go into each individual one, but just consider the hidden risk of the strategy. Sometimes strategies have a really, you know, quite dramatic hidden risk, and often it goes that the risk is so big that you don't hit it every now and then, but when you do hit it, it's game over. And there's variations of that, of course. Next one is ability to cut loose as well. So this is a real key one, guys, and something when I was developing strategies, you know, years ago, and kind of now when I'm adjusting and tweaking strategies, the big thing is, how does it deal with losers? How does it deal with cutting losers? Because everyone can come up with a strategy that's profitable. You're like, well, just buy dips. Just buy dips in a bull market, right? Fine, yeah, I get that's a profitable strategy, but okay, do it with leverage, and then you go, well, maybe the dips are 2 or 3, 4, 5, 6 times more than you expected. You're out of the game. You can't rely on that, or you do it so small size it's meaningless. You're like, well, I've been in this thing, it's dip, it's going to go to highs. Yeah, but you're in so small, it's meaningless size, there's no point. You may as well just put your investment invested and use no leverage and not be a trader at all. So ability to cut loose as well is a very good sign of a very good strategy, in my opinion. In other words, you know, if a trade's not working, it cuts it and it gets you out, and it's not really devastating to the P&L. It's not like it's eventually having to kind of throw up the position it doesn't like. It's good at cutting losers, because we tend to, if we're honest, we're looking at strategies, we're kind of looking at ideas, we tend to look at when it works. We don't look at when it doesn't work, unless you guys are back testing. If you're back testing, you've got that data. If you're eyeballing stuff on a chart and you're saying, yeah, that would have worked well, you tend to forget the times it wouldn't. So a good strategy is one that has a good ability to cut loose as well. And also, let me add to this, keeps you out of markets that aren't conducive to that strategy. I mean, that may be something you think of before, like a filtering process, but it keeps you from getting involved in a market that's just not going to offer you the kind of profits you want from that strategy. Let's just kind of summarize that. If it's a trending environment, it's something that says, hey, I've got to have these filters ticked before I'll even get involved in a trending environment. So it doesn't get involved with markets that are range bound. Next one will be provision to run winners. I think this is important. Do you know why I think this is important? Because I think that, you know, if you look at your P&L generally does this, and every now and then you get these good outlier moves, and they really help boost confidence. They boost your P&L, they help you ride down times, they help you ride stagnant markets. You need them. You need times when your P&L just has a nice spike, and your strategy needs to allow you for that. In my opinion, that's just personal. Some people might disagree with me, and that's fine. Some people might like just hitting those singles, accumulating that. But for me, I like the optionality of being able to hit a home run every now and then. And the strategy has to allow for that. And it normally means some kind of trailer in an operational perspective, some sort of trailer in the last portion of the move. Normally. Another thing is easy to execute. You don't want something that's really challenging and really tricky and kind of keeps a lot of your time if you haven't got it and you've got to do loads of research and this and that. If that's not what you want to do, it has to be easy to execute. So if you're looking like a really super high frequency scalping strategy, as a human, you're probably not going to be able to execute it. If it's something that's relying on multiple legs in and spreads and this and that and the other, again, you're probably going to be able to execute it. So watch that for that one. The other one is it makes sense. This is kind of the price action thing for me, is it makes sense. I understand who's on the other side of the trade. I think about who I'm trading against, where their pain point is, why the market's doing what it's doing, where it's going to move, why, etc. So, and it doesn't have to be that, but something that makes sense to you, whatever strategy you're using, pin bar type strategy, indicator based strategy, it makes sense because of X, Y, Z, because then you feel confident in pulling the trigger. And that's a very personal thing as well. Many people see a strategy, they don't want to do it because they don't believe it works, don't have confidence in it, take one, not take the other. So making sense is super, super important. Let me know what you think is an extra added thing to distinguish between a good and bad trading strategy. Yes, of course, profitable, but some of these things here, which you don't really think of, to me, are super, super important. Take care, guys. Keep your risk managed, and I'll see you in the next one. Bye-bye.